pre-tax profit increase of 7% at 1.7 billion, 5 billion for the year to date, with revenue growth, especially in our corporate bank and private bank businesses that are benefiting from the interest rate environment. But also, we think very credible performances in our investment bank and asset management, in the latter case that had inflows, as well as disciplined cost and risk management. So overall, we feel very good about the quarter that we've just closed.
When it comes to investment banking, though, FICC revenues were down. The overall unit didn't perform as well as in the past. What's causing this? What's dragging down investment banking at this stage?
Well, to begin with, the comparison quarter was a very strong quarter for us. And what we see on an underlying basis is a performance pretty much in line with the market. What's going on is the normalization of fixed income and currencies revenues that we called for, especially in the macro businesses, so rates, foreign exchange, and emerging markets, where they had benefited last year from the very high levels of volatility as the market was sort of adjusting to changes in interest rates. We do see that normalization taking place, but also, if you like, a rotation of activity into other products, notably credit products and financing, where we've seen strength. So that's the underlying themes, but we remain confident about the business and the outlook for it.
Now, I also noticed that you increased slightly your provisions for non-performing loans to 346 million. Could you just explain to us the rationale behind that? Are you expecting further defaults going ahead?
Well, we've been, as you can see in some of our public disclosures, we've been running at what we call stage 3 credit loss provisions at about the level of 350 now for several quarters. And so that reflects the credit environment that we're in. That's up from a relatively low number, relatively low level of credit losses over the past several years, but is in line with the guidance that we've given for the full year of between 25 and 30 basis points of provisions against average loans. So it's a credit environment that is a little worse than normal, or a little worse than a very strong environment that we've come from, but by no means a period of stress. We actually booked credit loss provisions of a little less than 250 this quarter, even with that 350 stage 3. And that's reflecting, if you like, the conservatism that we've had in our models up to date. So in short, credit environment remains, we think, pretty stable.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.